Okay, so good morning, everyone. In this spreadsheet, which I'm going to discuss with you, I want to discuss with you that how these basic things, how these basic calculations come in the picture. This is not even a calculation yet. I hope that we will be having enough time that we can discuss it today. But the idea basically is that how we make some interpretation of some financial data statistics, and if we can make sense out of that, that's very important. So in this spreadsheet, the name of the spreadsheet is, I guess it's risk return calculation. And this spreadsheet, by the way, is available in Optima in the study material section. And then you have the spreadsheets folder. So you can find it there as such. Now imagine an investor, you are as I said yesterday, that you are like my fund managers, the training fund managers. And I sent a client to you, and the client who is interested, you make out, oh, why I have so many messages? Maybe I should put my speaker, but then my recording will be affected. Or I actually remove this message thingy for some time, so nobody can send me any messages. So sorry about this. These technical things can be very awkward at times. I can get rid of this as well for momentarily. But anyways, so and you find out that this investor who is interested has $1 million. I hope you can see the highlighted cell. And with the due discussion, and you find out that this investor is having some kind of not overly tech stock lover, and at the same time he or she is not overly traditional stock. So the person is a very hybrid profile of investment. So the person is neither giving too much value to Apple nor too less value to Procter and Gamble, which traditionally is a very traditional stock. Apple is, of course, a technology stock. And you make that the investor wants to be in between these two extremes, these traditional and tech stock. And the investor, the client, which you have, is interested to know, should he or she go for investment or not? Or rather, you are making this calculation on his or her behalf and letting him know that, is it a good investment or not? Or should he go for a hybrid strategy or likewise? You will see it soon. You take some data of Apple stock price here. First of all, disclaimer, when you make this analysis, you will never make a judgment based on 5 observations. It's never possible. So keep in mind that this is only an exercise. When you see the other spreadsheets, which I will discuss with you in the class, you will see that sometimes we have the data for the last 10 years. 10 years daily stock price data. Normally, as we know that there are 365 days in a year, and then we minus these 2 weekends, so 52 weeks generally, and 2 weekends, so 52 multiplied by 2 is 104 days, plus there are some religious and other social holidays. So altogether, on an average, the stock market works for 250 days a year. So for 1 year, we have 250 average observations. And if you are analyzing the data for the last 10 years or even 20 years, then you can multiply 250 with 10 or 20, and that will make a very big spreadsheet. So my disclaimer is that you never make a decision on 4 or 5 observations, but because this is just a very basic task, so I'm giving myself some excuse to do it. Same way, we have the stock price for Apple, and we have the stock price for the Procter and Gamble. One theory you learn now, even though we are doing this spreadsheet, that you never make a decision to invest or not to invest based on the stock price. A higher stock price doesn't guarantee that you are going for a rational investment. And same way, the lower stock price doesn't mean that this stock is a junk. No. When you want to make a decision, because the stock price is an absolute measure. And what we need, the measure that we need, is a relative or comparative performance measure. Okay, for example, you get 80 marks in an exam. Are 80 marks good or bad? Somebody tell me. If you get 80 marks in an exam, are they good or bad? Good. Why do you say good?
Because from 100, it's not that bad.
Who said that the maximum marks are 100? Did I say it?
No.
No. So if I say that you get 80 marks out of 100, which I didn't say, then you can say that you got 80% marks. But if I say that you got 80 marks and the maximum marks were 1000, then basically the person is failing in the exam. So it means the absolute number is very, very confusing. So you never make a decision based on the absolute numbers. What we need, so these are the absolute numbers. You never make a decision based on the absolute numbers. What we need is the relative measure. A relative measure is the stock return. So look here, Apple stock price, Apple stock return. And how we get the stock return? The formula is B5. Today's price, the current price, minus B4, the previous price, divide by the previous price. So put the brackets. If you don't put the brackets here, then the calculation will go wrong. Make sure that when you want to convert the stock price to the stock return, you take the current price minus the previous price, put the brackets on both sides. I repeat, if you don't put the brackets on both sides, you will make a big mistake. And then you divide by the previous price. And that would show how much increase, how the stock price has changed over time. So you can, from here, you can make out that in 1 day's time, there has been approximately 10% increase in the price. So for example, if I try to change them into percentage, which I can, no problem. I need to format my cell. And all I need is percentage, maybe to 2 decimal place. Yeah, so there we go. And same way I can do here as well, so that everything is in percentage. Format, percentage. And here we go. So you can see that in 1 day, the Apple stock went up to 10%. And then look at the next day. Once again, your B6 become, the March 3rd become, on March 3rd is the current price, and March 2 is the previous price. Once again, put the brackets and divide by the previous price, which is March 2, okay? So this will be rolling over return, so daily return. And this we go on, and we find that in 5 days' time, there are 4 returns. Remember, if you have 5 prices, 1, 2, 3, 4, and 5, there'll be 4 returns. Return number of observations are always 1 less than the number of price, because you cannot find the stock return on March 1 unless you know the stock price of February 28th, because then you compare 2 dates. So there is always the rule of thumb, always remember that the stock return observations data is always one value less than those of the stock price. The same way, so you can see that the stock price was very up in the second day of when you purchase this. So basically you are giving a suggestion to the client that, hey, you know what, let's look at the history. So you are making some kind of historic analysis of Apple stock price. And you find that one day it loses, so more or less. So if you find the average of all these 4 stock returns, on an average, Apple has earned 3.42%. And then we have the Procter & Gamble stock price. So you can see that 1, 2, 3, 4, 5 stock prices. And we never make a decision based on the stock price value. We always make a decision on the basis of the stock return. Now, for example, there are 2 stocks. I just want to make a hypothetical example. The share price is 2,000 euros. Next day, it goes to 2010. And then there is a stock price, which is 2 euros. And next day, it goes to 3. Which one makes better result? The first one or the second one?
The second one.
The second one. Because if you look at the first one, the absolute value of the price is the stock is very high. But if you look at the comparative value, which means the current price minus the previous price, brackets are very important. Without brackets on both sides, you will make a horrible mistake, and that mistake is unpardonable. Make sure that you put the brackets on both sides. It's an arithmetic or a mathematical quality. Divide by the previous. So here you make basically nothing. You make 0.5% growth. I can change it to percentage to make it simple. Yeah. So 0.5% increase. But look at here. The stock price is very low. 2. Look at 2002. If you are a layman, if you are a layperson and you don't know this concept of return, then you will say, hey, this is great. But it could be a historic company. It could be established for the last 150 years. But this company could be a startup. So the stock price, the absolute price will increase over time. And here, when I make this calculation, brackets, the current minus the previous, divide by the previous, and that gives me, look at that. This format in percentage is very important that you have a common formatting, otherwise it could be a problem. Look, the stock price with very high value is making 0.5% increase in a day, and the stock price with very low value is making 50% increase. So this stock is basically hundred thousand times better, 1,000%. So if I, so you can see here that this second, the low value stock has performed 100 times better than the stock with the high value. So this, if you divide this by this, you will see 100 times, which basically means that the low value stock has overperformed the high value stock by 100 times. This is massive. Okay, so never get fooled by, never get deceived by the high values. Always look at the relative value, comparative value, percentage. Okay, so that's what we do here as well. Like we did the same thing we did here. We do this thing here, and then we get the return. Okay, one thing I want to tell you that Well, you know the Excel function. So for example, if I delete all of them, I'm sorry, I'm just deleting it for some time. But just for the reason I'm doing it on purpose. Normally, when you make this big data calculation, so you start with the bracket, the current value minus the previous value, bracket closes, divide by the previous value, you have one value, and then if you click here, you see this plus point. So if you can drag it down, or the way I don't drag it down because sometimes there are thousands of observations and dragging could be a problem. What normally I do, I just click here, it comes automatically. It comes automatically then. So this. What is this? Oh, this is nothing. This is not required actually. Okay, so these are the values which we got for Procter and Gamble. And if you want to find the average return, the way we calculate average here, we can calculate the average. We can calculate the average here as well. So what I do here, I can calculate the average. Average. So when I see average, and then I can select the data, or I can just type in if the data is too big, and that makes 1.35. So I find that when I look at the return, I find that Apple has overperformed Procter and Gamble. Are you guys okay with this? Yeah?
Yes.
You're
Yes.
fine?
Yes.
Okay. So the return of Apple is 3.42%. The average daily, look at word, be very precise. In finance, you have to be very, very precise. A comma, a semicolon, one wrong word, and you can give a wrong information to your client. So look at that. What I would say, the average daily return based on 5 days data analysis, I find that the average daily return of Apple is 3.42%. And here I say that based on the data analysis of the 5 days daily stock prices, I find that the average daily return of Procter and Gamble stock is 1.35%. So be very particular when you make. Now, I have a question for you. You are a fund manager, and a client is sitting in front of you, and the client finds that 3.42% is the average daily return of Apple, and 1.35% is the average daily return of Procter and Gamble. Is this information enough to make a decision?
No.
No.
Why no? Or somebody says yes. So Apple performs better than Procter and Gamble, and let's go for it. Let's go for Apple because Apple is better. Is this information enough?
No, because you still need
Still need what?
the risks of
Excellent.
risk.
Excellent. Excellent. Remember the phrase I used yesterday, no pains, no gains. So if you're looking for the gain, you must not forget the pain. So gain and the pain. And the pain is risk. And I expect that you must have studied basic statistics in your previous studies, in your previous life. The standard deviation, which is a measure of dispersion, the variation, is a very important measure. Standard deviation shows if a certain data is reliable, more the dispersion, the more the standard deviation, less is the reliability. of the data. And lesser is the standard deviation, more is the reliability of data. I'm making, again, this sounds very conceptual, but I want to give you an example. Do you play football or do you have interest in football, by the way?
Yes.
Yes.
You have? Okay. You know Manchester United?
Yes.
See that how can we move from finance to football? But it's very important. And how about AC Milan? Is anybody who likes AC Milan?
Yes.
No.
I'm a supporter.
Okay.
Man, you. I prefer-
Anybody likes Chelsea?
Yes.
Oh.
Oh.
No? Okay. If I have to make a voting now between Manchester United, AC Milan, and Chelsea, which is the most favorite team of yours? You can shout which team is the most
Manchester
favorite.
I
United.
think it's Chelsea.
Manchester.
His owner is very
Milan.
rich.
Okay. Should I say that the Manchester United is the first favorite of yours? Chelsea is number 2 and AC Milan is 3rd. Am I right?
Yes.
Okay. This is the purpose of this game. Okay. Now imagine matches. Okay. Let's say Manchester United plays 4 matches. 1, 2. I should say first game. First game. First game. Manchester United plays second game. Manchester United plays third game. And Manchester United plays 4th game. So I think 4 are enough. Or maybe 5th game. Five matches they play in the league. And Manchester United is scoring 4, 4, 4, 4, and 4 goals. In all the 5 matches they play, they make 4 goals. And then comes Chelsea. Chelsea is scoring 3, 5, 6, 3, 3. And AC Milan is scoring. AC Milan finds a very easy team, and they pump 9 goals into that team. 0, 0. And next match it scores nothing. Next match it scores nothing. And then it scores 6 goals in one match and 5 goals in another match. May I ask you one thing? How many total goals they have scored? Each team. How many goals each team has scored? Can you count?
20 goals.
Everyone, each team, or any team has scored more
Manchester
goals?
is 20.
Huh? Sorry?
Manchester
Each
is
team-
20 goals.
And AC
Every single
Milan?
one is 20 goals.
It's 22.
Really?
Yes.
AC Milan
Every
Ah,
single
yeah.
team has 20.
and Chelsea?
20.
20, yes.
So each team has played 20 goals, scored 20 goals, yeah, in 5 matches.
Yes.
Yes.
Do you think that they're equally good teams? Because obviously, in the same number of matches, each of them is scoring 20, 20, 20. So can I say that the performance
No, because
is good?
we don't have the number of goals of the other team, because we know that the goals, we know how many goals they mark,
Mm-hmm.
but we don't know how each team took. We don't know if they win the play.
Let me rephrase my question to you. If today you come to know that tomorrow Manchester United is playing its match, based on the history, so today you want to make a forecast. Today you want to make a forecast that how many goals Manchester United will score. Today you make a forecast how many goals tomorrow AC Milan will score, and today you want to make a forecast how many goals Chelsea will score tomorrow's match. Which team is easy to predict?
Manchester. Because they goals four times at the match.
And which one is very difficult to forecast?
AC Milan.
AC Milan.
And which one is in between?
Chelsea.
You have yourself have given me the definition of standard deviation. So it means that there's a more risk of betting. If you want to make some, I know there are people who make some betting, which is not, I don't do it and I don't recommend you to do. But I'm just making some kind of example that if you want to make some kind of betting, there is a more prediction that Manchester United will be scoring 4 goals tomorrow. And Chelsea, you know the range that they are between this range, but AC Milan is the most complicated team to make some prediction, because on one day they are fantastic, but on the other day they don't do good. I mean, just in the example, I basically I like AC Milan a lot. I have got so many my favorite players who played for AC Milan, and I love Milan first of all. So nothing can be wrong about Milan. Yeah. So you know the concept of now this. You know the concept of this standard deviation, but how we show it? Okay, how we show it? If I want to find the let's say return or performance of each team, return is a stock market word, but I just want to use it. I would use because return is a market performance measure, stock market performance measure, and then there is a risk. How much risk or uncertainty? Because risk comes from uncertainty. If I use average, and then I extend this formula to the others, I find that each team has given almost same amount of performance. So I can make it a little bit different so that they are bold and maybe red. You can distinguish bold and red, okay. Yeah. And if I want to calculate the risk, then I would use the phrase standard deviation. Look at this, STDEV. This is standard deviation, which is a measure of risk or uncertainty or unpredictability or unreliability. And here, when I extend it, I have different measures. Almost no risk in making prediction, forecast about Manchester United. Chelsea definitely is riskier than Manchester United. But look at this, AC Milan is the riskiest. Would you like to expect the same return from 3 different stocks with the different levels of risk or not? Can I ask you, are all this 4, and this 4, numerically they are same? Numerically they are same. But do you give them same value?
No, because Manchester goals 4 times at each match, so there is no risk at 4, and
Yeah.
the other there is risk with 4.
Mm-hmm. If I replace Manchester United with Marks and Spencer, this company, you know Marks and Spencer?
No.
Yes.
Marks and Spencer is a very famous retail. And I replace Chelsea with let's say British Petroleum, BP oil. And I replace AC Milan with British Airways. all three British companies so that the comparison becomes logical. And you are expecting 4% return on Marks and Spencer with no risk. Will you also expect 4% return on British Airways with this risk?
No, it's twice because we can have the same return of same return performance with zero risk.
Because here, if you are expecting 4% and you are willing to invest in British Airways, because British Airways is giving you 4%, because Marks and Spencer is also giving you 4%, then you're not a rational investor because there is no risk, almost no risk. Well, not almost, there's no risk in Marks and Spencer. Marks and Spencer is like investing in the treasury bond for 10 years. But look at British Airways. The risk is huge. So you can't compare apples with bananas because the nature of this 4 is not same as this. So you have to take into account the risk factor also. Risk factor is very, very important. So if you're only looking at the return factor and ignoring the risk factor, you're making a big mistake. Okay, so same thing. Did you like this example? So we learned with the football goal and we try to move them to the stock market dynamics. Okay, so the risk is measured. The message I want to give you is that the risk is measured. The standard measure of risk calculation is the standard deviation that we study in statistics. And you don't have to learn it because you can use in Excel, no problem. So here we go. So the risk was, you can see that the risk is 6.32%. Yeah, so just standard deviation of return. So that's a risk. And if I, and you can see that the risk of Procter and Gamble is 3.474.
So, Shab, can I ask you about risk?
Yeah.
If the standard deviation is 6.32%, it means that my return would be 9.74, but also minus 3.
Minus, yes. Yeah.
Okay, thank you.
Yeah. So this is basically the variation. Okay. So yeah. So for example, if you are a risk lover investor, because we have the categories of investors, some investors are risk lover. They love risk. Then why they love risk? Because they are hunting for more return, but in the process they are prepared to take more risk as well. On the contrary, we have another extreme. Let me write it down actually, because otherwise. So I would say that this, when I look at this thing, if I put a comment, I can say that Apple, can you see I'm typing here?
Yes.
Apple stock is better option for risk lover investor. Because it gives you more return, but at the same time, it pushes you towards more risk. But because you're a risk lover, you are prepared to take risk. So you go for it. And then on the other hand, the Procter and Gamble is good for P&G is a better option for the opposite of risk lover is called risk averse. Risk averse means the person who hates risk, who want to be the beneficiary of the stock market, but tries to play. He's very like a Warren Buffett kind of approach, and not investing in the high-tech stocks, but investing in in the companies making bubble gum or these kind of Coke or Pepsi type of stocks. Very less risky stocks. So this is the, okay. So this is what the risk averse investor will go. But then you have a third category, which is a hybrid category. And those kind of investors are called, what we call them as risk neutral, who are mixture between risk averse and risk lovers, who are not extremely risk lovers, but they don't mind taking calculated risk as well. And how do you know it? That we know from the discussion, that when you discuss with the client and you find that the person is almost 50-50, or in this case 55% he's willing to invest his 1 million, or you convince him that you invest 55% in Apple, because not too much, but 55-45 ratio between Procter & Gamble and Apple. So the wealth would be split into 55% and 45%. And then you can calculate the portfolio return, which is here, right? And the same way you can have the portfolio risk. So this is the formula of portfolio return. You can see that. If you want to invest 55%, so you can say 55 D2 multiplied by C9, the average return, plus F2, the proportion invested in Procter & Gamble multiplied by E9, the average return. And then you find out that the portfolio return is 2.49. And you can see that the portfolio return is less than that of Apple, but more than that of Procter & Gamble, because it's a weighted average. It's an average. And same way, like you calculate the portfolio return, you also calculate portfolio risk. Okay. This is the formula. You don't have to memorize it. Please keep in mind, you don't have to memorize it because it's there in it's a formula, it's a theory, but you will hardly remember it. But you just know that this is how the calculation is done. It's a little bit of, it's not just all about statistics, but it's a little bit about mathematics also. I don't want to go into the maths. So there is a formula to calculate the portfolio risk also. And you can find out that the portfolio risk is 4.71%, which is less than what you, had you invested all 1 million in Apple, then your return would have been 3.42%. And risk would have been 6.32%. And had you invested all your 1 million in Procter & Gamble, then the return would have been 1.35% and the risk would have been 3.74%. But now, because you are making a hybrid strategy and you are more like a risk neutral investor who can take risk, but not too much, then your return is 2.49, which is between these two extremes. And your risk is also between these two extremes. This 4.71 is less than 6.32, but definitely this is more than 3.74. So you are following some kind of hybrid strategy. So if I can say so, I also need to make them bold and red so that you can distinguish them. And if I put my comment here, this strategy is used by, who was between risk lover and risk averse? Which third category was?
Risk neutral.
Risk neutral is used by risk neutral. Neutral. I'm very happy that we had discussion about this spreadsheet today. Honestly, I'm very happy. Yeah, so this is something like example. So what I would do now, it's almost time. So I have recorded it, but I have done some changes to your file, which you can see in Optima. So now after we hang up, I would remove that file and replace it with this file that we have now. Make sense?
Yes.
because I have put some more comments and done some this football teams examples as well. So that's what I would do. And thank you very much. If you have any questions, you can ask me now or whenever you wish to.
I have a question.
Mm-hmm.
To take a decision between invest between the two companies,
Mm-hmm.
is it good to calculate the difference between return and risk for each company and
Yeah. Yes. Yeah.
see?
That's what we have done. That's what we did because in our case we have a portfolio. We have a potential portfolio of two companies, two stocks. So we have done their individual analysis.
Yes, but the portfolio return and portfolio risk is the average of the two companies.
Mm-hmm. Yeah.
And can we do the same for each company? One portfolio return for the Apple and one portfolio return for PG or P&G, and the same for risk. And
Yeah. That's.
yeah, and after that, see
Uh-huh.
which is the best portfolio return and which is the best portfolio risk, and after that, make a decision and choose one company to invest.
Yeah. Look. If you are a very extreme view, normally I think we will go in a different category of discussion, but normally the investors want to be diversified. They don't want to put their money in one company, neither in Apple alone, in this example, nor in P&G alone. So the investors who is more like a not extremely risk lover or not extremely risk hater would like to choose some kind of combination of the more stocks. So you want to get the benefit of both stocks because we have a saying in finance that don't put all your money in one, don't put all your eggs in one basket.
Okay.
So
yes, I know that, but it was just a question like that.
yeah.
To know if it's possible.
As a matter of fact, if you are only investor in P&G, you're still taking a big risk.
Yes, yes.
So in that case, it's not a good idea to go in a very extreme view. Well, it could be a good view, for a good idea from people who have this kind of view. There are people who are specialists. There are some investment funds who are specialists only into risky stocks.
Okay, okay.
I have done a project for an investment company in Finland, which only invest in small cap technology companies. And what could be riskier than them? But they say that, hey, that's what our specialty is. We don't like to invest in the established old companies. We are only willing to invest in the new companies in the field, and that too in the technology stock. So people have a different risk appetite. We use the word appetite. Hunger for risk is different for different investors.
Okay, okay. Thank
Yeah.
you. Yes.
No worries.
Okay.
No problem. Any other comments or point you want to share? Okay, if not, or if there is any a point, we can discuss when we meet next week. Yeah, and I would be I have recorded it. I would be sharing. I haven't shared yesterday's recording yet, and I would send both recordings today. And I would send you the message in the discussion forum that, hey, this is the link for this recording and this is the link for this recording. And I will also make updation in this spreadsheet and replace it with the old one. No. Replace the old one with this new one. Sorry for my English. And thank you very much and have a lovely weekend and stay safe and happy.
Thanks.
Thank you.
Thank
Thank
you.
you.
Thank you. Bye-bye. See you next week.
Have a nice day.
You too.
Have a good day.
I haven't answered your chat, but I would copy the chat and I would see that if there is any urgent, I would get back to you, okay? Thanks a lot. See you. Bye-bye. Mm. Okay. All right. Okay. Good. So there is nothing urgent. Just normal chit chat. All right. See you then. Bye bye.